since I really started understanding the infinite banking concept, um, I've been trying to inform as many people as I know as possible because I just think it's so valuable to anyone, no matter what your financial situation or position is. So I want to try and just open up this discussion with practical, relatable scenarios about the concept. So to start though, how did you stumble? I'm just curious. How did you stumble onto this infinite banking concept? Like, was there a catalyst? Was it random? Like, what's your story behind it?
It's an odd situation and just an odd story, probably a lot different than most people. But it's actually the catalyst was my mom. She found it. She did research about it, and then she showed me. And when I saw it and learned more about it, and I got in contact with people about it, it just opened my eyes of what the impact it can do for people my age. Then also like just throughout more research, people that are professionals have their own profession, um, anything like that, and or just people that work 9 to 5. It can do many different things, and so that kind of caught my eye of just how much it can help people my age, just because things are getting more expensive. Housing is getting more difficult to get a mortgage for. And so being able to recapture uh, those payments by use like those expenses by using the policy. The first thing that kind of caught my mind of an idea is people nowadays they're looking to they have to get two or three jobs to just pay for their basic expenses and also just have money for entertainment purposes, vacations, and whatnot. Um, so my one thought from that was um, being able to recapture the money means more money is coming back to you, meaning you won't have to get that second or third job because the money that you're making is actually working for you and growing in value. And so you won't have to make or get multiple jobs to then suffice your needs
Yeah.
and wants in life.
Yeah. So I want to unpack a couple of things there. So you said a couple of times, like help people your age, like how, just for some context, like how old are you?
I'm 25 now. I turned 26 at the end of March.
Okay, cool. I'm curious to hear your perspective. I find people that I met, like IBC practitioners, like people who like actually understand this concept. There's a few common characteristics in these people who like truly see the value in it, and I think one of those is um, those who like really understand money and like banking and like the system and like the foundations that this system is based on. Would you agree with that? Do you find that's a common like characteristic of people who like really see the value in this concept?
Yeah, for sure. I think when people do a deep dive on the banking system and how like the deep roots of it, they see the flaws in it. Um, I just one example of just even several years ago of the new rule, the bank bail-ins. So basically, what that is, or so let's say back in 2008 when the banks collapsed, the governments bailed them out, some of those big banks out to help them survive. Several years ago, they came out, at least in Canada, came out with a rule called bank bail-ins. And so what that means is if the banks collapse like they did in 2008 and the banks need money, they can go into customers' bank accounts, take their deposits to then help them survive and get out of the like just get out of the problem there is, and that's a massive issue.
Yeah.
Just
So yeah,
from
that's a good point. I'm glad you brought that up. So when did that come into like law?
I don't know exactly. I told like 2018 comes into mind. I don't know exactly what year it was. I know it was recent, so not too far ago.
Yeah.
But it's just that's a massive thing, especially with the economy nowadays, that it can very easily happen, and not a lot of people know about it. probably a lot of people don't want to know about it just because of how scary it can be. Prices for things are like money's tight already. Now just heighten that with the bank just taking the money in your bank account, and they can do that because you've deposited money into the bank, so the bank now controls that money. So
Yeah.
that's a big thing that was recent.
That's so concerning, like bail-ins. Just the idea that you've worked like it's called decades saving up money, depositing into your account. You just like assume that it's safe and there for you when you need it. Um, but the fact that no one thinks this will ever happen, but like all you got to do is like study history past
It
like the
happened in
90s.
2008.
That's what I
It's
mean.
just the difference was the government bailed out the banks. Now they
Yeah,
came out with the rule with, oh yeah, just use the customers' deposits. Like you can
yeah,
wake up and banks can collapse in a second. It can just drop, and so you could
yeah.
wake up one morning and check your bank accounts, and there's nothing there.
And another thing with that is just the insurance deposit, CDIC, I believe, the amount of insurance that you're covered for in your bank is like 100,000. So if you have, in most Canadian banks, I believe that's the current figure, right? Is 100,000 that you're insured for. So if a bank goes under or whatever happens, like you have a few 100,000 in your bank account, um, just the thought that like only 100,000 is safe is also a little concerning to say the least. I would say.
Yeah, exactly. Like people have TFSAs, and then also savings accounts, things like that. So like it's just very risky. Hopefully it doesn't happen, obviously, but there is a strong possibility that it does happen. Like they put that rule in for a reason. Um,
Yeah,
it protects the banks and it also protects the government because then they don't have to bail out the banks
yeah.
that way.
And look, it's not even like a far fetched like theory. I mean, just look what's happening right now, right? With inflation, just the level of debt that Canada's in, every province is in. Um, just all that compounded. At the end of the day, the cards have to come tumbling down at some point, and it's usually always the consumer or the you and I who
Yeah,
foot the
it's
bill,
always
right?
us that has to face the effects of
Yeah.
other people's decisions.
Yeah. So one of the best definitions I've heard about infinite banking is it's the fountainhead from which all investments are derived, and like that resonates with me personally. That's like probably the biggest value I see in infinite banking is like not having to deal with the red tape and oversight of banks and other loan providers, and just having 100% complete control of your finances.
Yeah.
Um, how would you describe infinite banking? Like, what's your like definition of it if you're explaining it to someone new?
Basically, it's a safe storage to put your money, having it grow for the rest of your life, but also being protected for the rest of your life. There's a lot of living benefits to infinite banking, but then also you can't ignore the death benefit component of that, and having that increase every year to your needs and to match your needs. It is a big aspect of that, but definitely the main thing is having your money grow, compounding for the rest of your life that can be used for various expenses or various investments that some might want to get into. So for yourself, obviously, be the fountainhead for various investments, and that's correct because the policy continues to grow. You take the loan out, purchase or put the money towards an investment, and now you have that money is doing two things at once. For more just basic necessities, just having your money grow. Like your money's got to go somewhere. Let's put it somewhere where it's going to grow, and then once you have more wealth accrued throughout the policy, then we can start looking at uh, different investments to grow the wealth even more. So it's just like whatever the person, like whatever the clients, wherever they're at in their financial journey, we kind of start there. and then kind of move down the line that way.
Yeah. So to play devil's advocate a bit, one thing you said, right? Save storage for the rest of your life. Um, if someone hears that, it almost one of these things that sounds too good to be true. Like what investment is like guaranteed, right? Like how is infinite banking so safe where you can make that statement with just so much high level of confidence?
We just had to look back at history. There's insurance companies that have paid out a dividend for the past 100 years straight, and that's throughout all the financial economic crises that we've had throughout the past over 100 years. And so, and the insurance companies still continue to pay out a dividend. And so, and also the insurance companies and the insurance products have been around longer than many rules and regulations. And so the insurance companies kind of get to bypass some of those just because they have been grandfathered in through uh, over 100 years worth um, of just how they've been enforced and how they've been um, into the marketplace that way. And so just looking at history and how they're designed, that's a big thing as well. And also just history of how the insurance companies perform.
Yeah. It in a worst case scenario, right? Like in what event, what has to occur for like deposits of an insurance company to no longer be safe? Like is that I don't know, what does that look like? Like default
Uh,
of Canada, for example, or like
yeah, so I'm like they've been the insurance companies and investments that they do. Um, they could buy things from 100 years ago, and they're still earning profits from that. So it it's kind of tough to think about of what would be the worst case scenario. At the end of the day, the whatever the cash flows you have in your policies, it's vested. It can't just go down like your money in a stock portfolio. It can't do that. Like it is vested in that account. So I think I guess the worst case scenario would be they just don't pay out a dividend. But if that happens, then there's a lot bigger problems in the economy and in the world that we're facing at that
yeah.
time.
And fundamentally, right, insurance companies they don't operate on a fractional reserve system. So they
Correct.
can't leave
It's
a
a
loan
one to
without it.
one
Yeah.
ratio.
Yeah. Yeah, for sure. So another thing you mentioned, which I want to dive into, and about recapturing the money, right? We're living in high inflation, like you said. There's people working 2, 3 jobs just to pay rent and the basic things. So how do you then what does that mean then to recapture money? Uh, that's working for you, that's growing value, where maybe you can use that instead of working that second or third job. Like, what are some practical ways? Like, what does that look like?
Yeah. So whilst your policy continues to grow and then you capitalize on just various expenses, let's say you buy a car, let's say for 40,000, and you want to pay that back after for 5 years. Over that 5 years, the policy has now that those cash values have grown even more, and so let's say the cash values are at 60,000. So your policy is from purchasing that vehicle, it has now grown. Whilst if you do it just with cash normally, you would pay the 40,000 and that 40,000 would be gone. So you would lose out on the opportunity cost of being able to make interest uh, on that money. And so that's how you slowly recapture the payments because the policy continues to grow while rather than just paying cash for something and just never seeing a cent from that 40,000. Yes, you have the car, but the cash component, you don't receive anything back. So with the policy and it continues to grow, uh, you just slowly recapture some of those payments, and over time you would recapture the full thing.
So to put another way, then it's kind of like rethinking essentially at the core where that 40,000 is coming from. It's either going to come from your own like savings account, which if you take it out, that 40,000 is gone forever. But if that 40,000 is instead sitting in a policy, you can take that 40,000 from there, but it's still growing at 40,000. You're just leveraging it and
Correct.
using
It
it that way.
doesn't, when you use your policy, you don't interrupt the growth and the compounded growth of the policy. And so, let's say you have 80,000 of cash values in your policy, and you take a loan out for 40,000 for the car. It still grows at that 80,000,
Yeah.
and not the 40,000. And so that's different than just paying cash, because if you have 80,000 in your bank account and you take out 40, it's not like you're just losing all that growth. And so the main thing is of how you can recapture is just because of the uh, uninterrupted compounding growth in that policy.
Yeah. Yeah, that's like another practical example, right? People go on vacations, right? You have a family of four. Let's say you spend like a vacation is like 10,000, call it. Most people will save up 10,000 in their savings account and then like use that money for their vacation. Whereas if that money was instead sitting in your policy, it's going to be uninterrupted forever. It's still going to be growing at its dividend rate, but you're just leveraging that 10,000 for your vacation and just like paying it back over time. So
Yeah,
it's a win situation.
exactly.
Yeah. So there's some important dates coming up for Canadians, right? As we approach tax season, right around the corner, RRSPs thing. So that's the first one, actually, RRSPs. So, don't get me wrong. I can see advantages of RSPs and like contributed deferring taxes for some people. Um, but I also feel it's one of these things that's kind of been embedded into our like society is like you got to contribute to RSPs. Like most people don't know why or why it's advantageous or even to the point where if you like question that, you're almost kind of like frowned upon by like the average person. Like, why aren't you contributing to your RSP? But
Yeah.
so, what are your thoughts on RSPs first of all, and are there more advantageous options for Canadians?
Yeah, for sure. Like, my opinion on RSPs is that they're not a good product or tool to have, mainly because it's not like it's just tax deferred, and so you're going to pay that tax well in the future. And typically, with how the economy is, especially now times, we're going to be paying more taxes down the road. And so, would you rather just pay less tax now or more tax in the future, especially during retirement time when you're not making an income? And so, when that basically just means that when you're paying, or if you do have RSPs and then you want to access those for retirement time, your retirement isn't as enjoyable because you're bringing in less income because of those higher taxes. And so, to me, having a policy is just more beneficial, just because of you can access the policies tax free. Just with the loans, it's not considered income, so we can use the policies in a tax advantage way or a tax efficient way rather than RSPs. And also in the policy, if we use the uh, policies cash values for retirement income, the policy still continues to grow while we're using the income or using those loans. And so it's just a lot better way, because with RSPs, if when every year you take out an income, it's just lowering the amount of what's there, so it can't grow. But with the policy, it still grows at that same amount and gets higher and higher and higher. And so over time, policy still continues to grow whilst you're enjoying your retirement at a just more tax efficient way.
Yeah. Yeah, I see like RSPs, it's pitched as the benefits are, it's deferring your tax payable for the year you contribute. You're meant to, use it when you retire, quote unquote. But um, I don't know about you. Another assumption is that when you retire, you're going to be in a lower tax bracket. So
Yeah, so I just want to speak on that. Like, why? Why do you want to be in a lower tax bracket? You want to enjoy your retirement. Like, so why someone's saying, "Oh yeah, you'll be in a lower tax bracket," but like, why? You don't have to do
that,
that if you don't want
yeah,
to. Like, you want to
that's what I was
enjoy your
getting at.
retirement. You want to go out and travel. You
Yeah.
want to do all these things that you couldn't do while you're working. So why be restricted in a lower tax bracket?
Yeah, that's what I was getting at too. That was my point. So that's how it's pitched, right? That's how it's
Yeah,
framed. But I look at it. It's like I don't know about you, but I plan to be in the highest tax bracket when I retire. Like the same as now. Like I plan to continue being an entrepreneur and
yeah,
making money, and so like I have no intention of being in a lower tax bracket. But
exactly,
so that's one thing, but another thing is that's also assuming that the tax rates are going to remain the same as they are now, which
exactly.
if you're assuming that, like, call it 30 years out when you quote unquote retire,
Yeah,
that's putting a lot of faith and trust into government, which we have seen is not the best at keeping promises. And you can look at historical like rates
yeah.
too on how taxes increase. So
And with
yeah.
a lot of our taxes now just pay the interest for the debt that Canada has. And you see how much spending that we're doing now. So we're going to feel the effects of it in 10, 20, 30 years. So it's a good assumption that taxes are going to be at a higher rate. So you might possibly not be at a lower tax bracket by it's just a lot of what ifs. And if you look at historicals, it doesn't seem logical of what they're saying.
Yeah. So sticking on RSP then. So instead of, let's say, contributing to an RSP, again, just to play maybe the other side, you're losing that tax deferral, or the tax. You essentially are paying a bit more taxes if you don't contribute to an RSP. Doesn't have that deduction. So what would be the alternative? Put that money into a policy and have it grow.
Yeah, and have that compound for the rest of your life. And you're able to access that money way before retirement time as well. Like you own the policy, you have control of those cash values inside the policy. So you can use the cash values that were meant to go into RSPs, you can use them at a much earlier year that can be used for investments for passive income. And then so you could use that for to fund your retirement even at an earlier year. And so it's just a lot more flexibility in the policy because you control the rules, you control the cash values, you have more control over the decisions that are made because you're making the decisions. You're not like with RSPs. A lot of the times, there's someone else making the rules, just making it just constricts you of what you can do. And just with the policy, since it is yours, you have more control and it's a lot more flexible.
Yeah. So another scenario, sticking to tax season coming up. So um, as an entrepreneur, as business owners, very seldom you're going to have a tax refund. You usually have a tax liability come this time of the year. So how do you use a policy for your own taxes? Like paint the scenario with that.
Yeah, so it's kind of what we talked about earlier, being able to recapture expenses with business owners, self-employed individuals. Uh, we're gonna have to pay our own taxes, like we're gonna file all that, and so every year we'll be able to be paying taxes. So it's a big expense that we're gonna have to pay every year. So why don't we just put it somewhere where it's going to grow, and over time we recapture those payments and those expenses for the taxes. So you can roughly gauge how much tax you're going to pay for that year, and put that into a policy each year, and then have that grow, and then take the loan out for the taxes, and then slowly repay that throughout the year. And a good thing about the repayments in the loans is that you control the debt of that loan. And so every loan repayment that you do, it just gives you more available cash to use because you own it rather than paying taxes. Uh, Normally, you pay them, never see that dollar amount again. So you're just able to recapture it because the policy continues to grow, and then you're just leveraging the policy whilst it's continuing to grow for those taxes because you're gonna have to pay them anyways. So might
Yeah.
as well just make it bank more efficiently, have that money grow for you, and then use that. And then over time, you'll be just it'll just be so nice to see, okay, in 20, 30 years, how many dollars of taxes would I have lost just by paying it with cash? And then you can kind of see of how much money that the policy has grown by. And you'll just be so thankful that you started it when you did.
Yeah. So, let's say hypothetically you have a tax bill come at this year at like $30,000. You have a cash value of 50. You're taking a loan out for that 20,000 that you owe in taxes out of your policy, but it's being uninterrupted. It's still growing at that 50. You're just paying off your taxes, and now at that point, um, you're controlling when you pay that back into your
Yeah.
policy. So talk about
Yes.
the control part. To me, that's the biggest advantage, like just having complete 100% control on the payback schedule. So unlike a typical loan or like a line of credit, let's just say, where you have to pay the interest like every month, or you have your payment due at the end of the month, or whatever the case is, this is a little different in that case where you have full control. So can you talk about that a bit, and like what does that mean, control?
Yeah, for sure. So typically how we pay loans or debt is that there's a fixed schedule over however many years that we have to pay. And if not, we have to give up that asset. So let's say it's a car. If you don't pay the car payment, they can take the car. With the policy, since you control it, you make the rules. That's a big thing. So with a car or for whatever, they make the rules of the repayment schedule. So just of the control aspect, say you have a loan, let's say the month one, you don't have to pay it. Month two, you don't have to pay it. And so it just gives you the control and flexibility to manage your assets the way you want to rather than someone else controlling them. And so since you control the debt, there's no fixed repayment schedule. It's very flexible to what your scenario is. So let's say you're tight on cash for the first 6 months, and then the other 6 months, if we're talking about taxes, typically you'd want to pay them in that year just so you have that cash available then for the taxes for the next year. And so if finances are a little tight for the first 6 months, perfect. You don't have to pay them back. And then in the next 6 months, you can kind of uh, do the repayments that way, and it can just be chunks of, let's say if it's 30,000 of your taxes, if it's just chunks of, say 10,000 for 1 month and then 5,000 the next month, or anything. It's totally flexible to what you want to do, and it just gives you more control and just less stress of, oh, I need to pay this, like the daunting loan repayment in the back of your mind, like, oh, I need to pay this, rather than in the policy it's super stress free, and just because you have the control and you make the decisions of when you want to pay them back, and
Yeah.
how much you want to pay back.
Yeah. Like for me, just having the control over the cash flow every month is the biggest benefit by far. But how is that possible? How do these insurance companies allow you to like take out a loan out of your policy and like pay it back whenever you want?
You own the policy. It's as simple as that. You own the policy, you own the cash values. They don't ask ask for when you say I want a loan, like I want to take out money in my cash values. They don't ask what it's for. They don't, because it's your money. And if you want to bring that back to a typical bank, if you want to take out money, you have to do credit checks. They ask for what it's for, all these questions, all these applications, and it seems stupid because it's people think it's their money in the bank, but it's not. You've given up the power and control to the banks to just hold your money. But in the policy, you're the policy owner. You control the policy. You own it. It's yours.
And what if you don't pay it back?
You just don't pay it back. So whenever you do pass away, so how that would work, whenever you do pass away, the loans outstanding would just be subtracted out of the death benefit. So no one's hunting you down for to repay the loans. Say you do pass away with loans outstanding, they just minus it out of the death benefit.
Yeah. Yeah. You see, that's the part where to a lot of people, it's like kind of perplexing in a way. Just the thought of having a loan that you can pay back whenever you want. If you don't want to pay it back, you don't have to. I think that's the part that for the average person is like, what the hell are you talking
It's
about?
it's so different than typical loans because all of our loans typically and traditionally we don't control, we don't own the loans. But when we do own the loans, we have control and the flexibility of what we want to do with it. And so just it's just a lot better way to bank, a lot stress free way to bank because money is a cause of a lot of stress in people's lives. And so with the policies and have that grow, it just kind of gives you a peace of mind and just the control aspect of loan repayments. It's nice that way as well.
Yeah. Why is this concept or the infinite banking concept more important now, like during times of inflation? Like, is it more beneficial now during these stressful times, or does that not make any difference?
It definitely makes a difference just having that policy grow with inflation. So that's nice. But like inflation has been around for forever, for as long as our lives, and even longer. So it's always been a thing. So even when the inflation was at 2%, you're still losing money just keeping your money inside the bank because of that 2% inflation. But even especially now with how prominent it is in our economy and how like every outlet has talked about the effects of inflation, having your money grow inside your bank is a very powerful thing because everything else around you is increasing. So all your expenses increasing. The thing that's not increasing is your income. Your income doesn't grow with inflation. And so the money we have in our bank accounts, we need to have that growth with us and work for us in order to stay ahead financially in life.
Yeah. So I know a lot of people that work in the financial industry and insurance, and pretty much none of them know about the infinite banking. They might have heard of the concept, but like they don't really understand the details and like why it's so valuable and useful. So, like, why isn't it just taught more in the finance world and insurance industry?
It's very specific on how they're designed. And so advisors of the Nelson Nash Institute, who's the founder of Infinite Banking Concept, we have years worth of education that we've done. And a lot of advisors like, oh yeah, I know how to do this concept, but they really don't. And why they don't do that, like why they don't go into infinite banking, it's just they might not know, like they might not even know about it. And why they don't know about it is just it's just not mainstream of that. Like if everyone had infinite banking policies in Canada, their the government, the Bank of Canada would be I don't want to say useless, but their use case would be a lot less because people don't have to rely on banks. And so what that means is banks can't make as much money as they did. And so I think that's why it's not as mainstream as it once was. But in the mid 1900s, everyone had whole life. policies and participating whole life policies. A lot of um, big corporations got started because of participating whole life policies, and it's just that's kind of why the creation of IB Canada Group, the group I'm a part of, that's why the group was formed because we're all independent advisors, uh, but we do have the common goal of just educating all of Canada on the infinite banking concept, just because we do see the value in it, and we do see if even 10% of the country had policies, like how much of a healthier economy we would have.
So do you think then it's by design that more like people in the business, like actual insurance brokers and agents who are actually selling whole life policies but like don't know how to structure an IBC policy, is that by design or is that just, you
Yeah,
know?
a lot of it, I'd say, is by design. Um, some other advisors might just work with one company, but there's a few companies that have very good uh, participating whole life policy products, and so they're just limiting themselves of who they go to for insurance companies. But I do think it is by design. It is very different structured. It's not just an easy kind of just put numbers together. Oh yeah, this is what the policy is. It's very it's kind in a way it's like financial planning, because we do need to have a grasp and a information of the client's financial scenario, what they want to do with the policy, like what's kind of like their thoughts and ideas and stuff. So it is more in depth than just a typical uh, insurance policy. So it
Yeah.
is a lot design and just structure.
Yeah. So like when I like went into this rabbit hole, learned about infinite banking and just got deeper and deeper into it, one of the things like you learn about is like how very few people or insurance brokers and advisors actually know about this concept. And uh, I remember for myself, like I actually like tested that theory. Like I purposely reached out to several just like insurance brokers, people I knew, referrals that were just like, general people in the industry. And um, no one knew about the concept as nearly as much as I did, which was like very shocking to me. And there seems to be a lot of like like misunderstanding or like misinformation about whole life policies. Like, a lot of insurance brokers will tell you that, you got to like earn a lot of money. It's expensive, which is not true, right?
Yeah, it's not. It's all dependent on each person's financial scenario. It's all having your money grow compared to not having your money grow in your bank account. It's as simple as that. You might as well put your money somewhere where it's going to grow. And so, majority of people have an income and they have the money inside the bank account, but the money inside the bank account doesn't grow. So, a simple solution to that is put it somewhere where it's going to grow. So, even people that don't make crazy high net worth, high income individuals, they can still uh, benefit from these policies just by allocating the money that's in their bank account into these policies. So uh, just it doesn't have to be just a rich person product.
Yeah, no, for sure. What's the current dividend that a policy is making out
Uh,
right now?
Depends on each company. So the three I work with, um, the one is at starting in April. It's at 6.25. Then the other one was uh, July or June of last year is at 6.1, and then the other company is at 6.05. So around 6%
Yeah.
as a rough of a.
And is that typically the average, like throughout like the 100+ years?
It all depends on the what's going on in the economy. So when say 15 or basic 10 years ago, like within the 10 years that we're in a low interest environment, just with mortgages, car loans, all that stuff. And so the the dividend in the insurance companies wasn't crazy high. I think it was like, oh, maybe like 4 or 5% from just looking at just historical that. So it's kind of um, equivalent to what's going on in the economy. However, where they do put the money is in very safe, low risk investments. It's not tied to the stock market in that sense.
Yeah. So where do they put their money? So like if you're depositing this money with an insurance company, what type of assets are they then investing that money in?
It all depends on each company and kind of what they want to go down in. Um, so you could see uh, a good amount is in bonds, so like 30-year bonds, so they have time to accrue in value. Also, various real estate acquisitions, like you see a lot of the buildings and a lot of plots of lands are actually owned by insurance companies. And so since they have been around for 100 years, they have 100 years worth of buying assets and just being able to receive dividends and receiving profits from those investments that have been around over 100 years. So various different things. It varies on each company and kind of what they want to diversify
Yeah.
themselves in.
And what about the loan aspect of it? So unlike a traditional loan that's compounded, let's say monthly, these loans that you take out of your policy, they're compounded annually, right?
Yeah, so well, it's simple interest. So um, then that's a big difference of your the policy is growing compounded interest, but then the loans are simple interest. So a lot of the times your policy is growing each day more than what the loan balance is. Um,
Yeah.
so it is simple interest for your rate is locked in for a full year, and then if you have still that loan outstanding, it goes into another year of what that current rate is. So it's simple interest for the loan.
Yeah. Yeah. And what's the rate right now, the loan rate?
Again, depends on each company. Right now, it's between like 7 and 8% of simple interest, but I've done uh, calculations of on an Excel spreadsheet of typically like a typical loan repayment at that 8%, let's say, and just the growth of the policy at let's say 6%.
Yeah.
And when I run the numbers, the policy grows by more than what the loan interest is.
Wow.
So people might freak out like, oh, there's a 2% difference of the loan rate, and that would be correct. But people have to be educated and understand the difference between compounding interest and simple
Yeah.
interest.
Yeah, absolutely. Yeah, it's a huge difference. So for people who are listening to this and hopefully piqued some interest, where's a good place to kind of start and learn more?
Yeah, so we have the group that I mentioned not too long ago. We have a website. It's called ibcanadagroup.ca or .com, and there's videos about infinite banking of more information. There's also all of the advisors that are part of the group. So I'm only licensed in Ontario. So let's say there's people watching that are interested in, let's say Saskatchewan or Vancouver or British Columbia. There's advisors in those provinces that can help you out. So yeah, just uh, go in on ibcanadagroup.com or .ca and then kind of go from there.
Awesome, awesome. And if someone wanted to reach out to you, learn more about you, where are you hiding on the internet?
I'm on LinkedIn, so you can contact me there just at Hayden Padalino. Then also email me, Hayden Padalino, IBC at gmail.com.
Awesome. Uh, Hayden, man, I really appreciate it. Again, I hope this conversation spurred more people's curiosity, interest in this topic. It's something that I love. I want to just everyone I speak to, like I literally, if we're talking about this subject, like I bring it up. So I'm just trying to spread awareness as much as I can. So I appreciate you taking the time.
Yeah, no problem. I appreciate you for having this platform and being open to sharing it. It's good that there's people out there that do want to share it. That aren't advisors. So I do appreciate you and your podcast, and also having other advisors like myself on your platform.
For sure. We should definitely do this again sometime. And thanks again. We'll chat soon.
Yeah, for sure.